Today, we raised the policy interest rate by 100 basis points, 1 percentage point. By front-loading interest rate increases now, we're trying to avoid the need for even higher interest rates down the road.
We are getting closer to the end of this tightening phase, but we're not there yet. We know that if we don't do enough now, we'll likely have to do even more later.
The Bank of Canada has raised its key lending rate 10 times in the last year and a half, all in the hope of wrestling inflation to the ground. And the annual rate did just dip a bit, but here's the thing. Inflation going down still means prices are going up, just not as fast.
Folks often mix those up, thinking that this inflation thing is going to be over and we're going to see prices as they existed in 2019. That's never going to happen. They might not go up as quickly in the future as in the past, but that's sort of the best we can hope for.
So if prices are still going up, how can people catch up?
One of the solutions for workers is wage increases. That is the solution to inflation. Try to get a raise from your boss, talk to your unions, try to get a better deal the next time you go to the bargaining table.
Sounds pretty straightforward, doesn't it?
Hey, if it works, I think it's great. Everybody can get a pay increase tomorrow and solve the inflation issue.
He's being cheeky in case you missed that. What's that joke? Put 10 economists in a room and you'll get 11 opinions. He subscribes to the long-standing school of thought that says wage increases can actually increase inflation in two ways. One, higher wages lead to more spending. More spending means more competition for goods, and that pushes prices up. And two, when businesses increase wages, they pass that cost on to the consumer in the form of, yeah, you guessed it, higher prices. That's the Bank of Canada's view too. This economist would know, he used to work there.
The big concern that they have is that wages are increasing at more than 5% and actually accelerating. So the concern there is, are we seeing more of that wage pressure building up? And if it continues, that might prompt the Bank of Canada to be considering increasing rates in the near future.
Now you might be asking, how would that help the average Canadian? People who are under financial pressure and are hoping for a raise, but are now hearing if too many people get one, interest rates might spike, which would only add more financial pressure. Enter our third economist. She argues the way the bank thinks about inflation needs to change.
Frankly, wage growth is good for Canadians. Central bankers have been looking for wage growth for over a decade. That's not where the focus needs to be. The focus needs to be on what are the future drivers of inflation and why do we need to think about prices differently than we have in the past several decades.
She says those drivers will increasingly be linked to global factors like climate change, factors the bank can't influence through interest rates. Now, we could contact another 7 economists, but ultimately it's his opinion that counts. And so Canadians will continue to wait and worry about what Tiff Macklem will decide to do with interest rates in his next update on December the 6th.